Imagine waking up to a headline you hoped you would never see again. Inflation back at 10%. Not a blip. Not a rogue month. A pace that compounds like a runaway snowball sliding down a mountain, gathering speed, gathering weight, and crushing the assumptions we built our lives on. Prices don't just rise, they reprice your future. 10% isn't an inconvenience. It's a regime. Here's the uncomfortable truth most people miss. Inflation at 10% doesn't only make things cost more. It rearranges power. It shifts wealth between borrowers and savers, between governments and households, between companies with pricing power and those without. It punishes long promises and rewards speed. And if you don't adapt quickly, it quietly taxes your plans until they can no longer stand. So what actually happens when inflation hits 10% again? First, the time horizon of decision-making collapses. Consumers stop thinking in years and start thinking in weeks. The question becomes, should I buy it now before it's more expensive next month? That forward pull of demand can briefly make the economy look strong. Shops busy, order books full, but it's a mirage. You're not richer. You're rearranging purchases before the next price jump. That's phase 1, the rush. Phase 2 is denial. Businesses tell themselves it's temporary. They nibble at margins instead of moving price. They hope shipping will normalize, commodities will cool, the currency will bounce. But input costs creep, wages rise, and that temporary squeeze hardens. CFOs start every meeting with the same question. What can we reprice? What can we substitute? What can we cut? Phase 3 is the scramble. Pay packets demand catch up. Unions reawaken. Contracts get shorter. Price lists get footnotes. Suppliers insist on automatic escalators. Some companies step into the storm like champions. They've got brand, scarcity, mission-critical service. They move price and keep volumes. Others discover their business was built on discounting. They move price and volumes vanish. The market starts separating wheat from chaff in brutal fashion. Meanwhile, the financial plumbing creaks. At 10% inflation, a 1% yield on cash is daylight robbery. Savers revolt. They move funds into anything that looks like protection. Short-duration instruments, inflation-linked bonds, dividend payers, real assets, commodities. Long bonds? They become toxic until yields reset. The arithmetic is merciless. When the price of money reprices, anything valued on distant cash flows gets dragged back to earth. Central banks can't ignore a double-digit print. They talk tough first. Then they act. Policy rates climb. The old joke that higher rates are coming next year turns into painful reality this quarter. Mortgages reset. Variable payments jump. Landlords pass it on. Households who treated low rates as normal discover they were living in a once-in-a-generation subsidy. Housing volumes fall before prices do. The sentiment turns suddenly, like a stadium exhale. Currencies tell the story in real time. 10% inflation is an accusation against a currency's credibility. If your central bank moves faster than peers, your currency might hold, even rally, because yield differentials widen. If it hesitates, capital votes with its feet. Import prices rise, and the inflation loop tightens its grip. That's why policy credibility is the anchor. Lose it, and the ocean gets very rough. Let's talk households. The first victims are those with fixed incomes and large, slow-moving expenses. Childcare, rent, food baskets that can't be trimmed without pain. They don't have pricing power. They have coping strategies. Substitutions. Bulk buying. Fewer discretionary trips. The middle class learns the new rituals. List prices are suggestions. Repair beats replace. The second-hand market is your friend. Small businesses face the crucible. If you can't raise prices and you can't cut inputs, you're a statistic waiting to be printed. But some owners rise to the moment. They shorten their cash cycle. They demand deposits. They renegotiate supplier terms. They pay staff sooner and vendors later, ethically, transparently, to keep oxygen in the system. In inflation, cash flow is king and speed is moat. The slow die. The fast survive. Investors rediscover words like quality, value, and pricing power not as opinions but as lifeboats. Fancy growth stories with profits promised in 2029 bow to businesses that generate cash now, with cost pass-through embedded culturally, not performatively. Energy, food, transport, staples, Parts of industrials, the places where necessities meet scarcity, those become crowd gatherers again. But be careful, commodities are snakes as well as ladders. When policy finally bites, they can roll over viciously. And then there's the psychology. 10% inflation turns every shopper into a trader. It encourages hoarding. It punishes patience. It rewards immediacy. But that mindset also sets the trap. People overbuy at the top of price cycles, then retreat when policy breaks demand. The whiplash is real. If you want to keep your footing, you have to do the opposite of your rising panic. Plan, ration, rotate. So, what's the personal playbook if inflation goes double-digit again? Number 1, shorten the duration of your financial life. Favor shorter-term savings instruments that reprice quickly. If your bank rate is insulting, move. Loyalty is not a strategy. Number 2, diversify your inflation defenses. Consider a mix of inflation-linked securities where available, high-quality dividend payers with proven pass-through, and selective real assets. Don't fall for the one-asset savior narrative. No single hedge works in every inflation regime. Number 3, kill lazy cash burn. Audit your household like a business. Subscriptions, utilities, insurance. Renegotiate annually. Price match aggressively. In a 10% world, failing to switch is volunteering for a pay cut. Number 4, be deliberate with debt. Fixed at low rates? Guard it. Variable with thin buffer. Prioritize deleveraging. In inflation, some debt is a gift if the rate is fixed and the asset is productive. The wrong debt is a quicksand disguised as a stepping stone. Number 5, upgrade your income, not just your budget. Inflation that big demands new skills, new value propositions, new lines of revenue. If your job isn't aligned with a sector or role that can demand higher prices for your time, start the migration now. Inflation rewards those who can raise their invoice without losing their client. Businesses need a different checklist. Raise price faster than comfort, slower than panic, and always with context. Give customers options, good, better, best. Push upgrades that protect margin with perceived value, not just higher numbers. Lock in supply early. Move from just-in-time to just-in-case for critical inputs. Tighten receivables. Incentivize early payment. Build contracts with indexation clauses. If you're not embedding inflation resilience into your terms, you're playing a fair game in an unfair world. Investors, remember the sequence. Early in the inflation surge, commodities and short-duration cash flows tend to lead. As policy tightens, the baton may pass to quality cyclicals that can stomach higher rates. When disinflation finally arrives, the longest-duration assets get a second wind. Your job is not to predict the exact month of the turn. Your job is to be approximately right and liquid enough to pivot. What about housing? It depends on the mix of rates, wages, and supply. If policy slams the brakes, transactions dry up first. Sellers cling to yesterday's comps. Buyers retreat to calculators. Rents climb until demand is exhausted. Then the adjustment shows up in prices, sometimes slowly, sometimes all at once. If you're buying, underwrite stress. Can your budget handle 200 basis points more? If you're selling, price ahead of the curve, not behind it. And the state? Governments face the cruel arithmetic of inflation. Tax receipts rise with nominal GDP, but so do costs, wages, benefits, index payments. The temptation to fiscalize the problem is huge. Subsidies, caps, windfall taxes. Some help, others distort. The most powerful policy remains credibility. Spend where it multiplies, cut where it leaks, communicate like adults to adults. Inflation feeds on mistrust. Policy starves it with clarity. There's a quiet danger in double-digit prints, moral fatigue. People get used to the abnormal. They stop expecting stability. That resignation is a slow poison in an economy. It makes businesses timid and workers cynical. The antidote is agency. Families reclaim control over the parts they can master. Owners rebuild margins through craft, not gimmicks. Investors rediscover underwriting instead of storytelling. Leaders tell the truth quickly and act faster than speeches. Does inflation at 10% last forever? Rarely. Regimes end. Either supply heals, demand cools, or policy gets ahead of the fire. But getting from too hot to about right can be a bruising journey. There will be false dawns. There will be costs. The winners are not those who guessed the peak CPI print. They're the ones who built resilience while everyone else wished for normal. So when the headline screams again, 10%, ask yourself 3 questions. What in my life needs to reprice today? Where in my business is the pass-through muscle weak? And which parts of my portfolio are pretending the old world still exists? Answer those without flinching, and you'll be miles ahead of the crowd still arguing with reality. Remember, inflation is a story about time. It steals from the future and pays the present at a terrible rate. Your job is to reverse that trade, to invest in skills and assets that future-proof your present. If this helped you see the roadmap more clearly, share it with someone who still thinks inflation is just a number in a headline. Like this video, drop a comment with the smartest inflation hedge you've ever used, and subscribe for more no-nonsense breakdowns. The link in the description or pinned comment has our full inflation playbook, practical checklist for households, business owners, and investors. Take it. Use it. Beat the regime.